Okay, so forget the heavy discounting. Victoria's Secret just proved that sometimes the best way to make money is to literally just stop putting your inventory on sale.
Right, forced promo detox. It's a bold move for retail right now, but it clearly worked this quarter.
It absolutely worked. So we are diving into their Q1 2026 numbers today, June 2nd. Oh, and the ticker is officially VSXY now. And you are listening to Earnings Unscripted.
The top line definitely reflects that new momentum. They pulled in $1.56 billion in revenue. They didn't specify a sequential quarter comparison this time, but year over year, they are up a very solid 15%.
Which is huge. Earnings came in at 56 cents a share. And real quick, just our usual reminder that this is purely our personal opinion, not financial advice. So please don't bet your retirement on lingerie sales.
Yeah, definitely don't do that. But if you look at their operating income, they improved from a net loss last year up to $76 million today. That is roughly a 280% jump year over year. And the tape completely lost its mind today.
It went absolutely parabolic this morning.
Total gap up. The actual trading quarter ended pretty flat, around $52, but pre-market today, it just rocketed from the mid-50s straight into the mid-70s, settled near $80, which is a 47% jump in one session.
47%. That is just wild for a legacy mall brand. It really feels like they are genuinely capturing Gen Z again. I read they had lines down the block in Soho at 1OM for the new Pink store, and apparently they have over 15,000 back orders on a single branded tote bag.
Well, scarcity sells. Average unit retail is up purely because they stopped panic discounting. But honestly, the cultural hype is masking a few things. There are some, let's call them accidental tariff quirks inflating those margins right now, plus an activist proxy fight that is quietly eating cash in the background.
I knew you were holding out on the catch. All right, let's get into the details then.
The biggest catch is right in their gross profit. Look, they beat on margins, sure, but a huge chunk of that is, it is pure luck. The Supreme Court struck down those old IEEPA tariffs back in February, so suddenly their import tax drops from 20% to a flat 10% global rate.
Wait, so they literally they just woke up and had a lower tax bill? Like no operational changes, just a court ruling?
Exactly. Scott Sekella actually called it out on the call. He said the tariff rate changes in the quarter favorably impacted gross profit by approximately $14 million. That is a massive 90 basis points handed to them on a silver platter.
Wow, okay. 14 million in surprise profit. I mean, I would absolutely take it, but I guess you were about to tell me why it does not last.
You know me too well, because they're modeling for that rate to snap back up to 20% by July. It's a temporary high, and they're bracing for a pretty hard cliff in the back half of the year.
Oh, sorry, snap back up? So the relief was just a tiny window before a new policy hits?
Pretty much. And right when that tariff cliff hits, they're also playing a very weird game with their supply chain.
Oh, I saw something about logistics. They're pivoting away from air freight, right? Moving almost entirely to ocean freight?
Yeah. I mean, it saves money on paper. But here's the thing. Ocean transit takes way longer. So from an accounting perspective, they have to take ownership of those goods weeks earlier. They're actually telling Wall Street to expect high single-digit inventory growth exiting quarter two, strictly because of this transition.
That feels kind of risky. I mean, tying up capital in goods sitting on cargo ships for weeks, especially with how fickle fashion trends are. Like, what if the whole Gen Z pink wave cools off, all the shirts are somewhere in the middle of the Pacific?
Right. My skeptic alarm is definitely ringing there because it's the perfect cover. If consumer demand suddenly stalls, well, they can just blame the bloated inventory pipeline on the ocean freight transition.
That is so cynical, Miro, but honestly, kind of brilliant.
It's structural reality. You always hide risk in plain sight. And honestly, they need the cover right now because the C-suite is totally distracted by something else entirely.
Oh, right. The activist investor drama, BBRC.
Yeah, BBRC built up this massive stake. Management actually had to adopt a poison pill rights plan just to block them from getting control, expiring May 2026. And this is not cheap. They flagged $7 million in proxy contest fees just for quarter two.
$7 million. Jeez, just to fight off your own shareholders. I was actually listening to Hillary Super on the call, and she sounded, I think the word is annoyed. She essentially said, while we respect all shareholders, we believe this campaign is a distraction from the significant progress and momentum we are building.
Translation, leave us alone, we're fixing the margins. But honestly, $7 million is a real cash drain when your free cash flow is already under a microscope. Cash dropped 60% quarter over quarter, down to $207 million.
Right. They had over $500 million in Q4. Some of that was seasonal draw, sure, but a 60% drop is steep. Add in buybacks, add in proxy wars, it really paints a more complicated picture than just long lines in Soho. So where does this leave them heading into the next quarter?
It leaves them incredibly confident, at least on paper. They are guiding Q2 top line up 9 to 11%. So basically breaking the 1.6 billion mark. And they actually raised the full year operating income guidance, a massive $120 million bump from their previous estimates.
120 million? I mean, that is not a rounding error. That is management just planting a huge flag in the ground.
Yet they are projecting between 550 and 580 million for the year. The assumption there is that the margin expansion really holds up because they are sticking strictly to that disciplined promo strategy.
Which makes total sense when you hear how Hillary Super framed the demand. She made this comment on the call about their core demographic and said, when you think about the 50 and below customer, she is likely choosing not to spend in other places in order to spend with us.
That is a very aggressive thing to say out loud right now.
It really is. Just casually assuming you can steal wallet share in this economy.
But honestly, she might be right. I mean, if teenagers are queuing up at 1 a.m. for a store opening, they are probably giving up spending somewhere else to do it.
Sure, but cultural hype has a half-life. They have undeniable momentum today. The issue is they're racing the clock against those tariffs returning in August and those proxy fees piling up. The real test is if the brand heat outlasts the structural headwinds in the back half of the year.
Right. It feels like they've bought themselves some very lucrative breathing room this quarter. Now they just need to prove they can hold on to it.
Preferably before all that ocean freight gets delayed at the port.
Okay, fair point, Miro. We will definitely be watching how that inventory pipeline actually shakes out. But I think that covers the big story for Victoria's Secret this time around. And hey, if you want these earnings drops to just automatically show up in your feed, go ahead and follow the show. We actually generate this podcast with the help of AI to see if we can turn dense financial data into a genuinely human-sounding chat. So let us know if that is working for you, or toss us a ticker request at earningsunscripted@datamadness.ca, or just grab the X link in our show notes. Thanks for hanging out, and we will catch you next time.
Take care, everyone.